Okay, we can all agree that learning is not easy. Okay, just turn up, take books and read is not easy. And most of us, we are working. Okay, even if you are not working full time, in one way or the other, you have something doing. So some of us, we are doing national service. Okay, I know it's not easy. Taking books to learn is not easy. I've been there before, but we have seen all these things, or we have considered all these things, and we decide to write what? Write the exams. Okay, so it means that that is not going to be an excuse. Okay, because we have considered all those things, but we still want to write the C exams. Okay, so let's try. Okay, I wasn't able to enter, but I haven't been in the auditorium for long, but if you look at it, you see, it's although CA will not automatically give you job, but if you look at the incitement, the feeling over there that they will mention some people they are coming from members and they will mention their name that they are coming to take award. You can imagine the feeling, the fans and all those stuff and the feeling. Although it's not automatically going to give you job, although the value of CA has reduced, but at least you might be needing it for promotion and all those stuff. So let's just put in the energy and do whatever we want to do. Okay. And another one too. I've met one, let me say he's my father because he's older than me. Okay. So I met him. He was looking for me, although it was raining, but the rain was disturbing, but he was looking for me, was asking me that he wanted to meet me. Not for anything, because he said he really struggled for corporate reporting. Like he has been writing, he's not getting anything. But someone said he should come. Okay, although first he was doubting, so he have to go to my YouTube channel and watch like YouTube channel of Assurance Professional School and watch videos there. And he was convinced with how the things are going. So he registered in November. He wasn't able to get it. He was still getting 40 something. So the match, he was following the things that I'm saying that do this, do that, and those things. And he was able to pass. And he was there talking to me like for about 30 minutes. Me too, I was tired. So I just had to tell him that, okay, since he's around, maybe I'll find time and come and see him. Okay, what I'm trying to say is that it doesn't matter the number of times that you have written the paper. Maybe you cannot feel like maybe you know that you know this. No, 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 no. Maybe if you know it, might not be you might not be writing. So forget about whether I've written the paper before or whether I know this, whether I've done this, whether I've know this, whether I've done this, and just go normal. Like just learn like you haven't done anything before. You haven't seen this thing before. With that one, maybe that feeling of I know will not worry you. And I keep on telling the university students, you see, all the most of the things that you have done, okay, it's just for academics. They cannot help you to maybe excel in the CA exam because we are going beyond those particular things when it comes to what to the CA exam. So let's try our best. Let's leave the issue of I know I've written this one before, I've done that before, and those kind of things. Let's leave all those things inside or outside and do our best. Okay, the exam is not expensive. You need a certificate for something. Okay, please, let's just do it. Okay, you won't learn and die. I haven't seen that. They say someone is learning and the person dies in the process or whatever. No, it's not going to happen. So let's try our best and maybe whatever we want to use the certificate for, whatever we want to achieve, God will help us to achieve that as well. So that is what I want to say. Let's, if you're not able to join the class, okay, I know some of the recordings they are plenty, but you can just find time maybe watching small. You can watch pause. You can watch and pause so that you don't come and watch again. So you can watch and write maybe whatever you want to write, or you'll be taking note that you have to watch non-stop without writing anything. It means that nothing is going to stay there. So maybe you can watch, you pause, maybe you try the question yourself, you play and see whether it is correct. If it is not correct, you can correct it. Then you move on. Like as you are playing the video, maybe you are doing notes or you are studying at once so that you don't come back to it again and you feel like it's too long and you cannot watch. So let's try our best and make time so that everything will be fine. If all the students are passing, me, I'll be happy and we all be happy. Yourself, you'll be happy. And if you are if you're not able to make it, you'll be sad. The same way you also be sad. Okay. Because if you're not making it, you have doubts of what either registering with us or something like that again. That is going to spoil our business. But if you're able to make it means that okay, you have a feeling or you have a trust or you have assurance that yeah, things will be okay because you have passed. So it means that you can do the next one and pass. And we all be in business. You also be enjoying your life, and we also be uh enjoying our life as well. So let's try our best and put in whatever it takes to pass whatever paper that we are writing. If it is corporate reporting, whatever paper that you are writing, let's put in our best. We know that learning is difficult. Okay, learning is difficult, but that should not be an excuse because you have considered that before registering as a student of what ICA. The exams are not difficult, but just that they are plenty. The things are plenty, so you need to cover a lot of things before you can be able to maybe do a lot of stuff. But maybe by the grace of God, you can also do something and get your 50 marks and go. Okay. And those who are aiming to maybe you have to receive awards today. The overall best students, the the CEO, the president of the council, all those people have to stand up for that particular person, and they have to be they have those police people. They brought that live ban or something. So yeah, the feeling. Okay, it's not anything. I'm not sure the people who are getting overall best in as just a subject. It's just books that have been given to them. So they just customize the manual. Maybe uh, if it is financial reporting, maybe if you are level 2 and you're going to level 3, they can just customize maybe advanced taxation and maybe advanced audit and give it to you. That one is not anything. But don't worry, we are going to give you money for taking that award. Okay, so if you can get it, fine. If you cannot get it, pass and move on. Okay, so let's try our best and see whatever we are going to be doing. So today we are going to be finishing issues on the capital reconstruction and reorganization. So we have done internal one. Okay, we have done internal. What do we mean by internal one? Internal one is we are going to maintain our existing business with its name and just try to turn things around. So maybe we can sack management, we can reduce our share capital, or we can maybe dispose of non-productive section of the organization, or we can discontinue some portion of the entity that is not doing well. So we do an overall activity, overall what scheme to make sure the company comes back with its normal ways of what making profit. It is going to be the same company. So if you want to do the same thing for Cocoa Board right now, we still maintain the name of Cocoa Board, but just that we do a lot of things to make sure that the company is actually able to come back to its original way of what making profit, how it was established first, without any results. That's how we go about it. Okay, but we can have a situation where we say no. This company, which is Cocoa Board, maybe the Cocoa Board is having a bad name. It's because of the name that they are not doing well. So what we are going to be doing is that we now establish a new firm and transfer the assets and liabilities of Cocoa Board to that firm now. So what will happen is that we are establishing a new firm altogether and transfer the assets and liabilities of the old firm to the new firm. So it means that we are going to close down in one way or the other. We are going to close down the old firm. So Cocoa Board will not exist again. A different company will exist, but will be doing what Cocoa Board is doing. But it's not going to be registered as Cocoa Board. We are registering a new firm altogether, and we are now transferring the activities of Cocoa Board or the assets and liabilities of Cocoa Board to the other one. Okay, this is seem like a cell. What do you mean by cell? Okay, you can see why we are saying that this is seem like a cell is like this. Okay, let's come here. Okay, let's come here. The company is always owned by which of the shareholders? A company is always owned by which of the shareholders?
Ordinary share.
Ordinary shareholders. Okay, fine. So the assets of the entity is going to be for the ordinary shareholders, but the portion will be for those that they are owing, the outsiders. So we look for the portion of the entity. Okay. If we are now transferring the activities of the entity to a new firm, it means that we are taking the company from the old owners to now a new owners. Let's come to this situation, very simple situation. You see something I've put debit or credit over there. I will not do that debit or credit. Or we learn it in the two ways. Then you pick the one that you are comfortable with. Very simple. Okay. Let's come here. Let's come to this situation. Very simple. Okay. We are saying that we are going to transfer the assets of the old firm or the liabilities of the old firm to a new firm now. We are still going to be carrying out the operations of the old firm, but we are not going to carry out that operations through the old firm. We will now establish a new firm altogether and continue with the operations of the old firm. So we are saying that assets and liabilities will be transferred if it is necessary. So we come here. Let's come to this side. Okay. I'll do this. Let's see, we have the old firm, let's say, which is AB Limited. So we are transferring assets and liabilities. Let's come here. Okay. If you are transferring assets and liabilities, this is what we do. Let's come here and see that property, which is land and building. Property, which is land and building. Let's see the old firm is 10,000. And let's see plant and equipment. Plant and equipment, let's say it is 15,000. Let's say we have the current assets. Let's say current asset. That's just the total current asset. Let's say we have 17,000. Let's say we have current liabilities. So current liabilities is 10,000. Let's say we have non-current. Non-current liabilities. Let's say it is 8,000. Let's now come here. Let's say we are establishing a new firm, ABC Limited. Okay. This ABC Limited is what we do. Okay. Let's say we are transferring the property. The question is saying that property will now be transferred at, let's say, 12,000. Plants and equipment. Plants and equipment will be transferred, let's say, at 13,000. Then current assets. Current assets will be transferred as, let's say, 19,000. And the current liabilities will be transferred. Liabilities will be transferred at their carrying value. So let's say liabilities will be transferred at their carrying value. Let's come here. What is the value of the property that we are transferring? What is the value of the property that we are transferring?
12,000.
No. Not what is the value that we are transferring before?
10,000.
10,000. Okay. Now we are transferring as what?
12,000.
12,000. What is happening there?
There's again of 2,000.
An appreciation of 2,000.
Okay, that 2,000 will be for which that 2,000 will be for, is it going to be for the owners of the old firm or the owners of the new firm?
The owners of the old firm.
The owner.
The owners of the old firm, isn't it? Okay. Let's
Yes.
come to plant and equipment. What is happening?
It has reduced.
There's been
Reduction.
There's a reduction of what?
2,000.
2,000.
So we can say that property is increasing by, we have to calculate the gain for the old owners. So property is increasing by 2,000. But plant and equipment is reducing by what?
By 2,000.
Okay. Plants and equipment is reducing by 2,000. Okay. Then current asset, what is happening?
There's been an increase.
Increase of
2,000. Okay. What is the net increase now?
2,000.
2,000. 2,000. Okay. Let me also show how we can calculate this net increase. Let's come here. Okay. We are looking for this is going to be for the owners, isn't it?
Mm-hmm.
This is going to be for the owners. This 2,000 is going to be for the owners. Okay. I want us to do it like this. Okay. This is the total asset, isn't it?
Yes, sir.
In the old firm, the total asset is something like 42,000, isn't it?
Yes.
Is the 42,000 is the
Yes.
42,000 for all the or is the 42,000 for the owners of the company? Let me take it again. This total asset over here, is it owned by the owners of the company?
Yes. Right, I share with this.
No, think about it again. Total asset is what? 42,000. Okay, but we are having a total liability of 18,000.
No.
No.
Means
No.
it means
Means
there's liability of 80,000 there.
Okay,
yes.
so what would be the value of the asset owned by the owners?
That'll be the 42 minus the.
Okay, what are we
20,
getting?
it will be
That'll be 20.
24.
That will be 24, isn't it?
Yes, senior.
Okay, let's come here. What is the value of the asset that we are transferring?
It is 44,000. 44,000.
44,000.
The value of the asset that we are transferring is what?
44,000.
44. Okay, 44,000. 44,000. We are transferring the related liability to, isn't it?
Yes,
This is
sir.
the total asset. This is the total asset, which is owned by. So the liability is also 18,000. So what is the portion of the equity value we are transferring? What is the portion of the asset that we are giving to the new firm?
26,000.
26,000.
Okay. But the portion that should have been given to them should be what? 24,000, isn't it?
Yes.
Yes.
But we are giving what?
26.
26,000. So there's going to be a gain of what?
2,000.
2,000. Okay. So this one, what we do is just like we are selling. Okay. You are going to be transferring the asset from the old firm to the new firm. This asset will always be transferred at fair value. So it might be that some of the values we are going to transfer the asset at a value higher than the previous value. And that gain is going to be for the old firm. It's just like the old firm is now selling the asset to them at a new value. So the gain is going to be for the old ordinary shareholders. So the question will ask you, prepare accounts to close the books of the old entity or prepare account to close the books of AB Limited. Closing the books of the AB Limited means that you are going to remove all the assets. There should not be AB Limited existing again. So it means that we just assume that the assets of AB Limited has been sold to what? ABC Limited. So these assets are at carrying value. They are going to be at carrying value. So the question will give you information, but the information that they will be giving to you will not be based on the fair value. The question will not give you fair value, but the question will give you the amount that has been paid for the asset that we are taking. So they will give you information to calculate what we call the purchase consideration. Okay. So normally what we do is that we are going to be taking the liability from them. So it means that we assume the liability. The only thing that we are going to pay for is the net asset. Do you agree? The total asset that we are taking, we are not going to pay for the liability. So we are going to take the liability from you. You are having total assets of 42,000. Okay, this total asset, 18,000 is financed from what? Liabilities, isn't it?
Yes. Yes, it
Okay.
is.
So if we want to buy the total asset, it means that we will give you 42,000. Then you will take 18,000 from this and pay what? The people that you are owing. Is that the case?
Yes.
Then how much will be left for you? 24,000, isn't it?
Yes, sir.
Okay. But what is going to happen is that we are going to assume the liability. So the new firm will take the liability from you. So since we are taking the liability from you, it means that we are going to pay the liability ourselves. So if we are going to be paying the liability ourselves, we only pay for the 24,000, which is the net asset, which is the equity or which is the shareholders fund. Okay, the shareholders fund over here, preference share is not part. The shareholders fund, we are talking about equity holders. So we are going to be paying for the equity. How much should have been paid for the equity value? And how much are we paying? So we compare that to know whether there's a gain or the old shareholders are having a gain or they're having a loss. How do we do that? We do that in accounts called realization accounts. Why are we calling realization accounts? The asset of the old firm will be realized. What do you mean by it will be realized? It will be sold. It means that they will not own it again. As far as you are losing the control of a particular item, we say that we realize that particular item. So if you go to realization in taxation, realization can be a situation where the asset has been destroyed. A realization can be a situation where you have transferred the asset to somebody. A realization can be a situation where you have sold the asset. So we say an asset is being realized when it has been destroyed, when it has been transferred, when it has been sold or something. So since the entity, the AB Limited will not exist again, it means that they cannot claim ownership of this asset. So they have sold the assets. So we just ask ourselves, what is the portion of the asset that we are transferring, which is going to be the net asset, because you have total asset given to you in the question, but that total asset is not owned by you. The new firm will assume the liability. It means that they will only pay for the portion that you are going to own, which is going to be 24,000. Then you will now ask yourself, how much are they paying us? The question will give you these values, but they will not tell you to calculate how much they are paying. They will give you how the entity is paying for the equity shares. They will give you how the entity is paying for the equity shares, and they will give you how the entity is also settling the existing liability in the old firm. So we are going to be. I will do two. I will do how can you calculate the two? I will do two. So you do the one. You pick the one that you like. I will do the one based on the question that based on the steps that I've given in the lecture note, that debit asset and those ones. And I also do a different one, like how you do consolidation. Very simple situation. I will do those two. You pick the one that we do. So if I'm presenting it like this, I say you can also present it like this. But at the end of the day, we are going to be achieving the same answer in the same step that we are using. But just I don't want to make it complicated. So what we do is we determine the value of the old firm. How do you determine the value of the old firm? Very simple. Determine the value of the old firm is just like a cost. This is just like the cost of the item, the cost of the asset that we are selling. So that is 24,000. 24,000, that is a cost. Since it's the cost, it is going to be like debit side. So the realization account is just like profit or loss accounts. It's just like capital reduction account. So anything that is a cost will be at the debit side. Anything that is a gain will be at the what? At the credit side. Very simple. So we will go to what we call realization accounts. What do we mean by realization account? I'll count to something like this. Let's come here. So I will just open one asset account and I'll do the double entry for there over there for you to see. Okay. So let me just come here and do something here. Okay. Let me just come here. So let me have the plants. Let's have plant accounts. Okay. Let's have plant accounts. So we'll be having balance brought down over here to be, I'm sure that was the figure the one that we have from the old firm is 10,000. Okay. So no, it's not 10,000, it's 17. Plant and equipment is 15,000. Okay. This is 15,000 now. And we are going to be selling this. We want to remove this from our books. So it means that we don't want to have zero. We don't have to have anything. We want to write it off. Writing it off means that we are going, so I can write like I'm selling, but over here, I won't do the sales issue. So you can just like, this is just like inventory that I'm selling. If I'm selling inventory, then this will be taking the cost of the inventory will be taken to profit or loss account. It will be shown as cost against the revenue. Okay, it will be shown as a cost against the revenue because the item is 15,000 and I'm selling it for how much? So what I'll do over here is I will be passing entry for this asset. I will match the cost against the money that I'm receiving so that I will have profit But if it should be normal one, what we do is that we bring the cash that we are receiving over here. Okay, we bring the cash that we are receiving over here. So you can bring the cash that we are receiving over here. If the cash is 17,000, then you'll be having a profit of 2,000. So it means that you only send the 2,000 to profit or loss. Okay, that's one way of doing it. Another way of doing it is this one. I can say that I will send this 15,000 to profit or loss. Okay, I will send this 15,000 to profit or loss. What will I do? This 15,000 will appear in profit or loss as a cost. Okay, then I'll come to the amount that I'm selling. If I'm selling it, I'll come here. I will come to the process. I'll come to process now. This process is a revenue that I'm receiving. So I'll come over here and have this as cash. So I'm receiving cash. Let's say I'm receiving 17,000. So I'll have cash over here. The corresponding, this one will be profit or loss because it's money that I'm receiving. It's revenue. So I'll come here and say I'm doing profit or loss. Okay. What it means over here is you are seeing profit or loss at the debit side of process. It means that if you go to the credit side of profit or loss, you'll be seeing what process. So I'll come to, let's say, profit or loss account here. Okay. Then I'll come here. We are seeing profit or loss on the credit side of what? Of the plans. It means that if you go to the debit side of the profit or loss, we see a corresponding entry of plans. That will be 15,000. If you come here, you also see profit or loss at the debit side. It means that if you go to the credit side of this one, you see proceeds. So you see proceeds of 17,000. Okay. Then we'll be seeing profit from the disposal of what? 2,000. It's the same as you bringing the proceeds and bring only the 2,000 over here. So this is what I'm doing. I don't want to have anything in this particular account. I want to write off because the company will no longer exist. So their assets and liability must be written off. Their books must be closed. So it means that we are going to be selling these assets. So since we are going to be selling the asset, we have what we call realization accounts. We close this with realization accounts. Okay, which is 15,000. The meaning also over here is the asset that we are selling, the cost is 15,000. So the amount that we are receiving from, we just compare. So the amount that we are receiving from it will be a revenue. We are the cost of the item is 15. So the cost will be at the debit side. How much are we receiving? It will be at the credit side. Then we now find a profit. So we come here and have realization accounts. So it means that if you go to realization account, we see plans at the debit side. The realization account is for the old firm. We want to determine the profit or loss from transaction they are selling. It is assumed that they are selling. So we go to realization account. All assets from the old firm will be debited at their carrying value, like this one over here. I'll be having all assets debited at the carrying value. So I will do for this particular entry now. I'll do for the figures that we have. So I'll come here and have something like this. So let me come here. Let me do liability. Okay, let me do one liability. So let's count. We see the assets are, if you are preparing realization account, assets are always what? Debited with their carrying value because we are selling the assets. So how much are we selling? 15,000, the carrying value. So we want to determine the gain, like the first one that we have done. So I'll come here and come to this place. I'll come here and have, let's say, current liabilities. Okay, let me have current liabilities here. Okay, the current liabilities, they are having a credit balance. So I'll have balance brought down over here. Balance brought down over here as the opening balance to be, let's say, 10,000. So we don't want to have any current liabilities again. The current liabilities will be transferred to the new firm. So it means that it will not be here. It means that we have realized the current liability. So we come here and have realization accounts. We close the account with realization account. That is 10,000. Since we have realization accounts at the credit side of at the debit side of the current liabilities, it means that if you go to the credit side of realization account, you see current liabilities. So if you want to prepare realization account for the old firm, this is very simple. We just come here. I can do it in a both vertical and horizontal formats, but let's use the horizontal since that is what we are familiar with. Okay, so I'll just come here and do this. So I'll prepare realization accounts in the books of the old firm, realization accounts in the books of the old firm. So I'll come here. I'm selling all the assets. So all the assets, how much am I selling them? This is the cost of the asset I'm selling. So I'll match the cost against the revenue. So since this is the cost, it will come here. I will come here and have property because this is the asset I'm selling. So how much am I selling this? 10,000. Plants and equipment. Plants and equipment is 15,000. Okay. Then I'll come to current assets. I'll come to current assets. Let me write that one very well. Current assets. Let me write that one very well. Current assets. So current assets, I'll have 17,000. Please, what are we going to be doing? We are going to be subtracting the liability from the asset, isn't it? To get a portion that we are going to be receiving from the portion of the asset that we are going to be receiving from the old firm, because we're supposed to receive 42,000. But 18,000, we're supposed to receive the 42,000 and pay 18,000. But they are saying that they are going to pay the 18,000 themselves. So they are assuming the liability. It means that they are going to give us only 24,000. So how do we determine how we determine the 24,000? It's the total asset minus the current liabilities. So we need to take the liabilities of 18,000 from the 42,000. Please, which side do you think we have to put the liability?
To get the credit side.
Credit side. So you bring all the liabilities over here at their carrying values. Please, not what? Not fair value. The question might give you fair value of the liabilities. That is the amount that you transfer to the old firm, the new firm. But the liability that we are talking about over here, we want to find the carrying value, the value of your assets in your books before the transfer. We want to know that. So this will be at the carrying value. So I'll come here and have 10,000. I will come to non-current liability and I will have 8,000. So you can see that if I subtract all, I'll be having what? I'll be having the 24,000. Sometimes the entity can incur some cost, maybe liquidation cost, or maybe they can give you any cost. That cost will be an expense, so that cost will come here. The entity can incur liquidation cost, but the question can tell you that the liquidation cost incurred by the entity will be paid by what? By the new firm. So it means that will become a cost at the same time revenue, because we are incurring the cost, but they are still paying us. So it means that we are not spending anything. So you bring the cost here and still bring it over here again. Okay, you can see that our net asset over here is 24,000, isn't it? We're supposed to receive 24,000. Okay, we're supposed to receive 24,000, but based on the question, we are receiving 26,000. Okay, the 26,000 that we are receiving, where do you think we can put it? The money that we are receiving from the transfer of the asset, where do you think it can be? Debit or credit? Debit.
Debit.
Are you sure? Are you sure? If you add 26,000 to the debit, it is going to be 50,000 now. If you add 26,000 here, it will be what? 50,000. Is it going to give you the gain of? Is it going to give you the gain of 2,000?
No, sir.
No, sir. Okay. If you want to do this, it's not
Should be
you are
on
going to do
the
something
credit
like
side.
it's not that you are going to do 26,000 subtract 24,000. It's not how you are going to do it. If you want to find a gain, it's not going to be 26,000 against 24,000.
Yes, that's how it's going to be.
Okay. Now the 24,000 is at the debit side. If you are putting the 26,000 at the debit side, it means that you are adding 24 and 26. So if you want to do the subtraction, where will it be?
The credit side.
Okay. So this 26,000, it is the what we call purchase consideration. We call it
Yeah.
purchase consideration. That is the amount that we are paying for the net assets. So this we normally name this one as purchase consideration. So purchase consideration. So this purchase consideration will be 26,000. And you see that you'll be having profit on what? Profit or realization loss. So we call it realization gain or loss, and that will be 2,000. So this
Yeah.
side is revenue. This side is revenue. This side is cost. So anything cost should come here, anything revenue should come here. But we are bringing the liabilities over here because it's assumed that we are not paying the liabilities. So that is a gain for us. But that is not the case. We are bringing liabilities over here because we want to know the portion of the net asset that we are transferring. So since the asset is at the debit side, liabilities will be at the credit side to subtract. Okay. Or I can also do in a vertical format and add all the assets and subtract the liabilities. The same thing, if you are subtracting, if you have the thing at the debit side, you want to subtract, you put it at the credit side. If you have it at the credit side, you want to subtract, you put it at the debit side. Okay, that's how we go about it, basic accounting. Okay, but the question is this particular one. Okay, they will give you the fair value of the asset, but don't give you all. But they will give you information how you calculate the purchase consideration. How do we calculate it? Very simple. How do you calculate the purchase consideration? Very simple. They will give you how they are settling the equity shares of the new firm. So whatever we are going to be issuing to the equity shareholders is based on the net assets. Okay, it is based on the net assets. But let me also tell you something. I will do another one, which is I'm saying that we are doing this for only the net assets, which is the equity shareholders. We are finding the gain or the loss for the equity shareholders. Sometimes the question can give you information on preference shares in the purchase consideration. But what we are doing over here means that we are separating the preference shares separately. So we calculate the gain or loss on the preference shares account separately. But sometimes we can calculate the gain in total over here and share which portion of the gain is for the net asset or the equity shareholders, which portion of the gain is for the non-current liability holders or something. Okay, so let's come here. I will introduce something over here. Let's assume that we are, let's assume that, let's assume that the entity is taking the non-current liabilities. We are transferring the non-current liabilities. Okay, let's assume that we are transferring the non-current liabilities. Let me come here. Let's come here. Let's come here. Let's come here. Okay. Let me say that we are transferring. Let's say that we are transferring the non-current liabilities. Okay, we are transferring non-current liabilities as let's say we are transferring the non-current liabilities at 6,000, not at 7,000. Okay, we are transferring the non-current liabilities at 7,000. If you are transferring non-current liability at 7,000, how much is the non-current liability shareholders losing? How much are they losing?
1,000.
They are losing
1,000.
1,000. Okay, they are losing 1,000, isn't it?
Yes, sir.
Okay. So the question will give you information on the amount that we are transferring, and the amount will be given in the purchase consideration. If that is the case, please, we don't bring the 7,000, we don't bring the non-current liabilities again. So this is what we do. Okay, so come here. The question will give you the information on the purchase consideration. We are paying 26,000 for the equity shares, but we are also paying 7,000 for only the non-current liabilities. So what is the total amount that we are giving to the entity? That would be 33,000, isn't it? Okay.
Yes,
So
sir.
over here, I will not bring the 8,000, but I'll bring what we call 33,000. Okay. You can see that 33,000 over here, 26,000 is for the equity shareholders. Do you agree?
Yes, sir.
Yes, sir.
Okay. And 7,000 is for what?
Current
Effective
liability.
liability. They're not correct.
Current. Okay. So let me just do here. Let me bring equity here, 26, so that we can actually understand this. Okay. Then we bring the non-current liability over here to be 7,000. But what should be the value of the non-current liability here? What should be the
8,000.
value of it should be 8,000. Okay.
Mhm.
We're supposed to take 8,000 from what? From this. Because the carrying value of the non-current liability is 8,000. So for us
Yeah.
to find the net asset is going to be the carrying value of the asset minus the carrying value of the liabilities. But instead of us subtracting 8,000, we have subtracted 7,000. You can see over here that your Your gain over here will be only 1,000. Your realization gain will be only what?
1,000.
1,000. Do you agree?
Yes.
But this 1,000, please, this 1,000 is not for what? It's not the only gain for the equity shareholders. No. This 1,000 is like this. It's a 2,000 gain for equity shareholders minus 1,000 for what?
For the non-current.
For the non-current. So you are coming to share this particular 1,000 like this. 2,000 will be going to equity and 1,000 will be going to non-current asset as a loss. Non-current liability as a loss. So the next thing that I'm talking about is that mostly we calculate the loss on total basis and now share it among all all the fund providers. That's going to be very stressful for you. So me, I'm suggesting that okay, let's do the loss or the gain for each of them separately. So let's do for the equity only. Let's calculate a portion of the equity and calculate the amount that they are paying for the equity. We count to preference shares. What is the amount that is supposed to pay and what is the amount that they are paying, so that we calculate the loss or the gain for the preference shareholders also separately. We count to the debentures also. We do their gain or loss separately. Not that we have to calculate the total gain over here and try to share it among them. No, we don't want to do that. Okay, the same way I can also do this. I can also reduce the purchase consideration to this. Okay, so you also see something like this. I can reduce the purchase consideration to something like 22,000 for equity and 7,000 for non-current liability. And in this case, this will now be 22,000 here, and this will now be total give you this. You can see that we are going to have a realization loss of how much? Is it 3,000? It's 3,000. Okay. This particular 3,000 is the loss attributable to only equity shareholders. Is the total loss attributable to total equity shareholders?
No, sir.
Mm.
No, sir. Okay. How much is attributable to equity shareholders?
1,000.
1,000
No,
and one.
check again. Equity shareholders,
2,000. 2,000.
2,000. And 1,000 is for what?
Non-current liabilities.
No current liability. Because if you want to do it for only the equity shareholders, it means that we bring 8,000 here for the what? For non-current liability. I hope you agree with that one.
Yes.
And the realization loss will be what? Will be only 2,000. Okay.
1,000.
So me, I'm saying that in the realization account, do the only the loss for the equity shareholder because they are the owners of the company. So they are going to be realizing anything from if there's a gain or loss, that they are going to be the ones to enjoy it. So do it for only the equity shareholder. What does it mean? Take the liabilities that you're supposed to take. Just calculate the current value of the net asset. You compare with the amount that they are paying for the equity shareholder. Then you do it. You don't have to calculate the total gain and now come to share. If you're using 7,000 over here, it means that you are factoring in the liability over here is 8,000. The liability that's supposed to be here is 8,000. The liability value over here is 8,000. But you are subtracting 7,000. It means that you are increasing this place by 1,000. That 1,000 is for non-current liability holders, not the equity. So it means that whatever loss that you get over here, the 1,000 is included because you're supposed to subtract 8,000. So me, I'm saying that you subtract whatever is supposed to subtract, calculate the gain or the loss for equity shareholders alone. After that, you come and do it for the preference shareholders also alone, and also do it for the equity shareholders alone. So the question will be telling you to close the books of the old firm. If you are closing the old of the books firm, the old firm, the first account is utilization account. Then they also ask you to prepare their equity account. You have to close their equity too. They can ask you for preference shares account or whatever. But mostly is the realization account, the equity account, the preference shares account, and something. And they will now ask you to prepare. Uh, you now have to do some transaction in the books of the new firm. So they will ask you to prepare statement of financial position. So you prepare the statement of financial position. and you now use the asset. Okay, the asset will be transferred to the new firm at what? At fair values or carrying value. The asset will be transferred to
Fair value.
fair
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 value.
value.
So
value.
we use the fair value. This is for the new firm. So we bring the asset at fair value. It's just like they are buying the asset. It will be bought at fair value. Okay. Another thing that we do is we calculate what we call business acquisition. What do we call business acquisition? Okay. The company is going to be paying for, the company is going to be paying something. That's something that they are paying is going to be for as an asset. Are they paying the exact amount that they're supposed to pay for the asset? How do we go about it? Okay, you can see that they are going to be taking the asset at fair value. Let's come here. You can see the value of the asset in the year is 26,000. That's what they're supposed to pay, isn't it? They are taking the asset at 26,000, net asset at 26,000. Do you agree?
Yes, senior.
Okay, the asset that is transferred to them is 26,000. That is the fair value. They're supposed to pay this. It can happen that they are paying 27,000. What is happening there?
I'm paying 1,500 more.
Okay, and they are paying this 1,500 more for something that we are not seeing, isn't it?
Yes, that'll be good.
So we calculate goodwill also for this one. It's just like a normal business combination. Okay, but what we do, the difference between this one is that if you are doing consolidation, do we prepare account to close the books of the subsidiary?
No.
No,
If we should prepare the account to show to close the books of the subsidiary, it means that we'll be calculating gain on the transaction for the ordinary shareholders of the subsidiary. Do you agree?
yes,
Okay. But over here, what we are doing is that we are doing this for the parents, and then we take the new firm as a parent. So what we do under business combination is we just prepare the books for the parent. How do we do it? We add the fair value of the asset. So the fair value, the addition of the fair value of the asset is what we are bringing over here. Then the next one is we determine how much the parent is paying and how much they should pay. Then we determine goodwill. The same thing over here. The only difference over here is that we are calculating the gain that the shareholders of the old firm or the subsidiary is making. How do we determine that? We determine the carrying value of the asset that they are transferring against the amount that they are receiving. So the difference over there is the gain. And how do we determine the carrying value of the asset? They are transferring the net asset. It is the equity shareholders who are going to be losing ownership of this. So they are transferring their ownership. So we determine the value that is due to the ordinary shareholders. How do you determine that? It is they are going to give you the books, the value of the old firm. So they'll give you the carrying value. So how do you determine the net asset? Total asset minus total liabilities. That will give us the net asset. How much are they paying for this net asset now? The question will give you information to determine how much we are paying to the equity shareholders. So we compare with the net asset for the old firm and compare and see whether there is a gain there. Then we come and deal with the equity. We come and deal with the preference shares one by one. Maybe the preference shares might be 80,000, but we are paying 65,000. It means that they are losing 15,000. We determine that loss for them. Then we come to the venture holders. They might also be having like 20,000, but we are paying them 18,000. It means that they are losing 2,000. So it means that we give the 2,000 of the loss will be given to them, will be assigned to them. But what will happen is that the new value of the debentures now will be 18,000 in the new firm because we are paying 18,000. So we are taking it at 18,000. The 18,000 is the fair value. So we classify that one at 18,000. Very simple situation. You don't have to complicate things. Okay. So let's just demonstrate this with some question and see how we can go about it. So we try to solve one and use it to explain everything well and maybe during because I have a compilation of questions that will be given to you, okay, based on the standards that we have done so far and other stuff. So if I get to the house, maybe by Tuesday, I'll put them together and give it to you. So you can try them and send them to me so that I'll look at it so that I can correct it. Okay. Or if you are very convinced that you trust yourself, you can also solve it and if you're okay with it, that is fine. Okay. So that is not anything. You can solve and send it to me for me to look at it, or you can still what keep it if you actually trust yourself so much. Okay, whatever be the case, nothing is going to spoil. Okay, so I've solved this one. Okay, so I've solved the 15, but what will happen is I'll bring the 15 to intervention. So I'll solve the 16. Okay, I'll solve the 16. We have some other questions over there, but this one is somehow detailed than the other ones. The first two, 15 and 16. So let's try the 16 now.
Okay. 16. Brain Limited, a private a private limited company, has been in financial difficulties and has reported training losses for a number of years. The directors of the company invited the shareholders and creditors for a special general meeting where it was resolved that the operations of Brain Limited be transferred to a newly formed company, Dela Limited, with effect from August 2024. The latest statement of financial position of Brain Limited as at 31st July 2024 was as follows. The statement of financial position as at that date. Okay. Additional information. The newly formed company's authorized share capital comprised 5 million ordinary shares of 10 Ghana cedis per value each. Dela Limited issued 4 new ordinary shares of 10 Ghana cedis each, credited at 5 Ghana cedis each for every 2 preference shares held in Brain Limited. The preference shareholders agreed to immediately pay the balance on the shares allocated. Preference dividend in Brain Limited were 2 years in arrears. Half of the preference dividend arrears were settled by issue of fully paid ordinary shares, 10 Ghana cedis each in the Limited. The new company was the new company also issued 3 new ordinary shares of 10 Ghana cedis each, credited at 5 Ghana cedis each for every 5 ordinary shares held in Brain Limited. The ordinary shares agreed to immediately pay the balance on the shares allotted. The bondholders in Brain Limited agreed to be transferred to the new company on condition that the bonds would be convertible into ordinary shares after 3 years. The coupon interest rate for the convertible bonds was to be 8% per annum. Similar bonds with no conversion right attracted an interest rate of 10% per annum. Accrued interest on bonds was to be paid immediately upon taking over. Current liabilities of Brain Limited were transferred to Dela Limited at their book values. The brand considered valueless and therefore written off. Tangible assets were taken over by Dela Limited at their fair values as follows: property, plants and equipment, inventories and accounts receivables. Liquidation expenses of Brain Limited amounted to 6 million Ghana cedis and were settled by Dela Limited. Immediately upon takeover, Dela Limited invited its shareholders for a 1-for-5 rights issue of ordinary shares at an exercise price of 15 Ghana cedis. The average market price of the ordinary shares on cum rights basis immediately before the rights issue was 20 Ghana cedis. The issue was fully subscribed. Required. The following ledger accounts to close off the books of Brain Limited. Realization account, preference shareholder sundry members account, ordinary shareholder sundry members account. B. The opening statement of the financial position of Dela Limited as at 1st August 2024.
Okay, so if I'm the one giving this question, what I'll do is I'll start with the B part, opening statement, because I have information on the assets, inventories, and I have information on the assets. So I'll be bringing 29,200 38,404 asset because it will be at fair value. Then I'll have the liabilities too because they are taking the liabilities as their book value. So we transfer the liabilities to them at the current liabilities at their book value. So I will just bring those ones. But they are saying that we should close the books of Brain Limited, which is the old firm realization accounts. So that I will do so many stuff here, but you just have to pick whatever be the case, you'll be getting the fun answer. So you just have to pay attention to whatever is going to happen. All right. So I'll come here, realization account. I'll just do a realization account. What will I do? I'll bring the asset at the debit side because I'm selling the asset. So I have to know the portion of the asset that is due to the portion of the asset that is due to the equity shareholder. So our total asset is 4,700 and the total liabilities is 12,500 and 6090. So I'll just subtract it from that one. My I'll get my uh net asset. Then I will now calculate how much they are paying for the net assets. Okay, how much they are paying for the net assets. But I will be doing this in so many ways. So I will tell you how to go about the return earnings. You can either bring it to the realization account or you can send it straight forward to the equity account. At the end of the day, you'll be getting the same answer. So let me just come here and do question number 16. So I will be doing this. Okay, so this is about, so I'll be doing this in the books of Brain Limited. So Brain Limited, we do everything in the books of Brain Limited and I'll go to the books of the Dalal Limited. Okay. Okay. So in the books of Brain Limited, we have the A, let's just say I, we have the realization account. Okay. So I'll have this place here, I'll have here. So let's bring the assets. What is the carrying value of the assets? We determine what is the amount of whatever we are selling. Then how much are we receiving? So let's come here. We have plant and equipment is what?
31,750.
Okay. So property, plant and equipment is 30.
31,750.
Okay, 31,750. So I will tell you something about the brand too. You can decide to bring it over here, or since it is valueless, it means that you cannot realize it. You're not going to be getting any amount from it. So you can take it to return earnings very straightforward. But let's bring it over here since it's going to be part of the assets. Okay. But you're not going to receive anything from it. But let's just bring it. I will show you be getting the same answer. So let's have brand. What are we having?
4,800.
4,800. So you can bring is part of the asset, or but since you're not going to be getting anything from it, it means that the consideration that you're receiving, nothing will be given for the brand. So you can send the brand as a loss because that is worthless. It means that the shareholders will not receive anything from it, so they will lose that part. So that is a loss to them. So you can take the brand straight forward to equity account because it's a loss. The amount that they are going to be paying is not part of the what of the purchase consideration because they are not paying anything for the brand. But let's just still bring it over here. Then I'll show what I'm talking about. You'll be getting the same answer at the end. So let's go to the next one. What are we having?
Inventories.
Okay, we have inventories. How much?
4,310.
4,310. So we have accounts receivables.
Three eight four zero
3840. Do you have any other thing again?
That's all for that.
Okay, so let's come to the liabilities. Liabilities, you have to know that irredeemable preference shares will come. Okay. Irredeemable preference shares are not owners. So irredeemable preference shares, how much is it?
10,000.
10,000.
Okay, so we have 10,000. Okay. Then we have 12% bond. How much is it?
12,500.
12,500. Then we have accounts payables.
3090.
3090.
3090. Then we have bank overdraft.
Yes.
Okay. So what are we having?
2250.
2250. Okay. Then we have interest accrue or something.
Yeah, accrued interest on bonds.
How much is it?
750.
750. So we will get the carrying value of our assets now. I'll be doing this in so many ways, but you just pick the one that you're comfortable with. Okay. Another way of doing is this over here. Look at this. Look at this. The return earnings. The return earnings. Is it a positive figure or negative?
It's a negative figure.
Okay. If we are closing down the organization now, what will happen? Is that going to be something that is going to be a loss to the entity or a gain to the?
Again,
No, this what is happening here? The return earnings, what is happening? If you are closing that, is the return earnings reducing the equity or is it increasing it?
it's reducing the equity.
Okay, so it's reducing the equity. So it means that the equity value will just be 20,000 plus the revaluation surplus of 2,000 minus the 5890 because that will be reducing the retained earnings will be reducing it. You can see that the effect of retained earnings, the effect of the retained earnings, okay, the effect of the retained earnings, the effect of retained earnings on the equity is what is a reduction, isn't it?
Yeah.
Okay. If you come to, if we come to, if we are doing this for only the equity shares, if you come to the realization account, anything on the debit side is what is a reduction on the what? If the debit side is higher than, if the debit side is higher than the credit side, what is going to happen? Is it a loss or a gain?
It's a loss.
You will lose.
We are going to be losing, isn't it?
Yes.
Yeah.
Okay. So if I bring the retained earnings of 5890 here, would there be anything over here that will cancel the retained earnings?
No.
So it means that indirectly the retained earnings is going to be higher. This place is going to be higher than the credit side of 5890, isn't it?
Yes,
Yes.
sir.
Okay. So when we are writing retained earnings off under normal capital reduction, we treat it as an expense, isn't it?
Yes,
Yes.
sir.
So I can come and write the retained earnings over here. If I write it over here, it is going to be increasing the cost than the what? Than the revenue. This whole place is cost. Debit side is cost, and this is revenue. So if I put 5890 over here, it's going to increase this one. So you can decide to come and write the retained earnings over here, or you can go and take it from the equity accounts. They are all going to be having the same effects. Okay, but I would advise you that go and take it from the equity accounts. So we'll be doing the equity account to straightforward over here. So I'll take this one out. So I'll come to that down. I'll be doing equity account as, so let me come to equity. So let me come to equity accounts here. So let me have the equity accounts. Equity account is the old firm. So we go to the equity balance over there. We see some balance on the account for them. So we come here, we have balance brought down to be how much? 20,000, isn't it?
Yes.
Then we have revaluation surplus. Is that correct? Of 2,000.
2,000.
Okay. The return earnings reducing. So where do we put it?
At the debit side.
So we come here and put the return earnings here. Okay. Let's come to this place. I've said something about the brand too. I've said something about the brand. The alternative treatment of the brand is also like this. Let's come here. Let's come here. Let me go to the top now. They are saying that the brand is considered worthless. The brand is considered worthless, isn't it?
Mm-hmm.
Okay. The meaning is that any amount that we are going to be paying to the equity shareholders for the asset that we are receiving, would the new firm pay anything for the brand?
No.
No.
Yes.
No. So it means that whatever consideration that we are going to be receiving over here, brand will not be part of it, isn't it?
Yes.
So you can see that indirectly the brand is going to be a loss. The 48,800 is going to be a loss. It's going to be making the cost higher than the money that we are receiving, isn't it?
Yes. Yeah.
Okay. So instead of you treating the brand over here, you can alternatively bring the brand to this place. Okay. So let me write this one 5890. So you can bring the brand to this place. So you will not treat the brand over here because indirectly it's making the cost higher than the amount that we are receiving. So that is going to be resulting in a loss. So you can bring the brand over here or any asset that we are not going to receive anything from it. It means that it is automatically a loss. And this is a loss going to be reducing our equity because the loss will be given to the equity shareholders. So since it's worthless, it means that whatever amount that we are going to be receiving, the worthless asset or the goodwill or whatever is not going to be part of it. So you can bring it to the equity value as a reduction straightforward, or you can put it into the realization account, and that will be part of the loss that will be coming to the equity account. So the two are going to give you the same answer. So that will, if we are actually done, I will still show this one. Then you see that the loss, if if 4,800 is taken from realization account will be this. And if you add it to the loss of 4,800 that we are bringing over here, the total will give you realization loss that we have gotten. But let's be moving small, and you see something like that. Okay. So I'll come here. They are also asking for preference shares accounts. Let me see if I can do preference shares accounts here. Very simple. So let me come to sundry preference shareholders accounts. Okay. So I'll also do it how I will say I'll do it in two ways. You just follow the one that you are comfortable with. You don't have to actually limit yourself to one way of doing things. Okay. Let's come here. This is just like liability account. So preference shares is going to be redeemable. That is 2,000. How much is it? 10,000.
Yes. Yeah.
Okay. So let's go to the question now and read some information there. So we can now be reading and be doing the adjustments one by one. Okay. This one, they will always state this statement for you. Don't panic. It's not anything that they are doing. Okay. It's not anything that they are saying. Okay. The first statement. Okay. The first statement, they are saying that the newly formed company's authorized share capital comprise 5 million ordinary shares of 10 cities par value each. What do we call authorized shares? Authorized shares. Okay, let's
The
let's
share,
let's not waste time. Okay, yeah. Randy, you can talk now.
the shares the company has agreed to issue, the total shares they've agreed to issue to the general public.
Okay. So the maximum number of shares that the entity is what is legally authorized to issue. That's what we call the what the that's what we call the authorized share. It's not the shares that they have issued. What they are saying that the new firm that has been formed, they have the right now to issue 5 million shares at a nominal value of 10 cities. So whenever they want to issue shares, they can decide to issue at 10 cities or they can issue more than that. So they have been authorized. The time that they are registered with the registrar general department, they have the right to issue 5 million shares. That's what they are saying. And each share can be issued at 10 cities. So it means that their shares is now valued at 10 cities. But it doesn't mean that they have issued 5 million shares. No. It doesn't mean that they have issued 5 million shares. No. They are qualified to issue 5 million shares. And a share can be issued at 10 cities. That's what they are saying. So let's come here. Dela Limited issued 4 new shares of 10 cedis, each credited at 5 cedis each for every 2 shares held in Brain Limited. So Dela Limited is a new firm, and we are transferring the activities of what Brain Limited to Dela Limited, isn't it? Okay. They are saying that
Yes.
Dela Limited issues the Dela Limited issued 4 new shares of 10 cedis each, credited at 5 cedi for every two preference shares held in Brain Limited. Very simple. What they are saying now is that Dela Limited is saying that the preference shareholders in Brain Limited, we are going to give you 4 shares for every two that you are having. But these shares will be issued at 10 cedis. 5 cedi out of it will be relating to the value of the shares that you already have there. And you have to pay for the additional 5 cedis. Let me take that again. We are telling you that bring two of your existing shares for 4 because we are giving you 4 for every two. So bring two of your existing shares for what? For 4. So we are giving you 2 for 1. Indirectly, it's 2 for 1. Okay, whatever shares that we have, we give you twice of that. That is the meaning. But these shares will be, since you are a shareholder over there, okay, we are going to credit these shares to you at 5 cedis. It means that based on your existing shares, we are going to be giving it to you at 5 cedis. So 5 cedi of whatever we are doing to you is a payment for the shares that you already have. But since our shares are at 10 cedis, you have to pay for the 5 cedis now. So the shares will be given to you at 10 cedis. But 5 cedis of it is for settlement of the shares that you're already having. But you have to pay for the existing one. So it's just like this. Okay, I'm telling you that my shares are valued at 10 cedis. But you have 10 cedis, you have 10,000 already. But I will be giving you, I will be giving you, you have 10,000 Ghana cedis in the old firm. So we are saying that our shares are valued at what? At 10 cedis. So what will happen is that we are going to give you 5,000 of our shares at 5 cedis towards the payment of the shares that you already have. But you have to pay for the additional 5 cedi to now become owner of the company. That's what they are trying to say over there. So we just come here now. Okay. The Land Limited is giving 4 shares for every what? Every 2 shares. It means that bring 2 of your shares for 4. So the exchange ratio will be 4/2. Do you agree? The exchange ratio will be 4/2. Agreed.
Sir.
Okay.
Yes, I agree.
Multiply
Yes, sir.
by what is the number of the existing shares that they are having?
1,000.
Would that be 1,000? That would be 10,000 divided by 10. How that is 4, isn't it?
Yes, sir.
Okay. So that would be 1,000. So if we are giving this at 1,000, what is the number of shares that will be given to them? Would that be 2,000?
Yes, sir.
Okay.
1,000.
They are saying that these 2,000 will be given to you as what? At 10 cedi, but 5 cedi of it will be for the existing shares that you're having. And the 5 cedi, you have to pay cash for it. So it means that we'll be giving you 10,000 for the 10,000. And you have to pay for additional what? 10,000 because the shares will be 20,000 now. 2,010. But we are, the amount that you are having in the old firm is 10,000. So we are giving you the new shares, the 2,000 shares given to you. We are giving those shares at 5 cedi for the payment of this one. So 5 cedi out of the amount is for the payment of this. But you have to pay for the remaining 5 cedi so that you can have what? The shares now. So we are giving the shares in payment of the shares that you have. But we are giving you more than the amount that you're having. So you have to do a top up. You have to do a top up. So it's just like a swapping. You are doing swap. You bring the new one, then you now bring a top up for it. You bring the old one and you add money to have the new one. So this is what they are doing. Okay, let's come here. How much are we paying? So we determine the number of shares now. Okay. How much are we paying to the ordinary shareholders as the ordinary shareholders? How much are we paying to the preference shareholders now in settlement of their existing what? Value, the existing shares that they have in the old firms? How much are we paying?
10,000.
Okay, so I'll calculate that 10,000 like this. We can call this one also purchase consideration. Okay, so I'll come here. I will have this one. I will have 4/2 multiplied by 1,000 multiplied by 5 cedi. How that is okay. Okay. Then we have 10,000. You can see that we are paying 10,000 for 10,000. Do you agree?
Yeah.
Is there any loss over there?
No, sir.
Okay. So straightforward, this is what I will do. I will now go to the books of the new firm. So I'll now go to the books of the new firm. So I'll come to in the books of the La Limited. I'll come to the books of the La Limited. Books of the La Limited. I'll be doing first working. I'll be doing cash and bank accounts. Do you agree that cash and bank account will come in? Because the preference shareholders will be paying for the new shares now. Is that correct?
Yes, sir.
So I'll come here and I'll have preference shares now. Okay. Preference shares now. They will be paying 10,000. Do you agree?
Yeah.
Okay. What? Let's come here. Are we issuing them ordinary shares or preference shares?
Ordinary shares.
Ordinary share.
So it means that they will become ordinary shareholders in the new firm, isn't it?
Yes, sir.
So I'll also go here and do ordinary shares accounts in the new firm. So let's do ordinary shares accounts in the new firm. Okay, ordinary shares accounts in the new firm. And these ordinary shares accounts, the company, the new firm is not having any ordinary shares accounts. So we can't have any balance. It's a new firm that is coming to start. So they don't have any balance. So I'll just come here and do irredeemable preference shares. They are changing their shares to what? So this one, so I'll have 10,000. Do you agree?
Yeah.
And they'll
Yes,
pay
sir.
cash again. They'll pay cash again of 10,000. So in all, they are having 20,000 ordinary shares. Is that correct? 20,000 Ghana
Yes,
cedis.
sir.
Okay. But what I'll do is I want to put, there'll be a lot of cash over here. So I want to just put all of them. But let's just move on. Let me just write preference shares over here. Okay. Let me just write cash here. Okay. The shares that we're paying for cash. So we just have cash. The preference shareholders are paying cash of 10,000. That is fine. Okay. Let's go to another footnote. We are done with the first one. Very simple. You don't have to do anything. Okay. Another way of doing this is this one. Let's come here. Let's come here. Okay, don't worry. If I'm done with this one, I'll do it. I'll do the realization account in a different way for you. But don't worry, you do that one. Okay. But over here we are doing it for all in the equity shareholders. Okay. The third one is the preference dividends in Brain Limited were 2 years in arrears. Half of the preference dividend were arrears were settled by issue of fully paid ordinary shares of 10 CD in the La Limited. So let's go and calculate the preference shares now. What will be the preference shares every year?
1,000.
What will be the okay? But they are saying that they are 2 years in what?
Arrears.
Okay, what will be the impact of these preference dividends on the preference shareholders account? Assuming we are sharing money, how much will the preference shareholders be receiving in the old firm? In the
Uh,
old firm, they'll be receiving
1,000
12,000.
every year.
No,
2,000. That is
2,000.
they'll
1,000.
be receiving
2,000 times 2.
Yes.
they'll be receiving 2,000. So it means that the preference shareholders stake in the old firm is the shares that they are having, which is 10,000 plus the dividend in arrears, isn't it?
Yeah.
Exactly.
Yeah.
Okay. But how much are we paying for that? How much are they paying for it?
We are paying 10. We are issuing ordinary shares. Half of the
Okay.
ordinary shares. We are paying 1,000.
Okay. So we are paying 1,000. What is happening to the preference shareholder? They are losing what?
They'll be
1,000.
Okay. They are losing 1,000. Very fine. Very nice. So I'll come here and have preference dividends. And it means that the preference shareholders will have 1,000 of the equity shares in the new firm. How that is fine.
Yeah.
Yeah.
Okay. Don't worry. I will calculate this and I will use the realize. This is the first part of it. So the first part we see that do everything for equity, do everything for preference shares, and do everything for the other ones. So very simple. Okay. But we can do realization account and determine the loss, the total loss the total loss for the company, which is including preference shareholders and equity shareholders. Then we now take our time to share it one by one. That is going to be stressful, but I'll still do that one too for you to see. Okay, let's come to. So we are done with that part. Okay, let's come to that particular part. So we come here and have the four. The new company also issued three new shares of 10 cities. The new
Hello, Senior.
company, yes, please.
Please, I want to ask a question. The dividend that we have issued half, that is 1,000. The
Yeah,
other half, where will it be recorded?
it's a loss. Okay, we suppose the preference shareholders are having 12. They supposed to have, if we are closing at a company, the money that's supposed to be given to them is 12,000. Okay, this is not reconstruction where you only bring the thousand. No, you are paying for only thousand. This is you are transferring. So I'm owing you 10,000. That is the money that you are giving to me, but I'm also owing you 2,000. So if you want to close the company now, it means that you are going to be losing 12,000 because the 10,000 that you have is gone. The dividend of 2,000 is also gone. So indirectly, you are losing 12,000 from the firm. Okay. Now they are saying that 12,000, we give you 10,000 for the 10,000, but we give you 1,000 for what? For the 2,000. It
Okay,
means that the
2,000.
preference shareholders will be losing 1,000. So that will be done in the preference shareholders account. That will be a loss. Okay.
All
That will be a loss for them. So
right.
we just
Thank
use it to close the account as a loss. Okay. We just use it to close the account as a loss. So let's come here. The new company also issued three new ordinary shares of 10 each, credited at 5 CD each for every 5 ordinary shares held in Brand Limited. The ordinary shareholders agreed to pay immediately the balance on the shares allotted. So this one, they are telling you that we are not giving the shares to them at what? At 10 cities. No. That's what they are saying. The shares are credited at 5 CD. So the shares that we are giving to you, we will issue those shares at 5 CD for the settlement of the old one. But the remaining balance you have to pay. So first of all, we need to know the number of shares that we are issuing to the shareholders of the old firm. They are saying 345, isn't it?
Yeah,
So the ratio will be 3/5 multiplied by what is the shares that they have?
2,000.
2,000. So what is the number of shares that we are going to be giving to them?
1,200.
Okay, 1,200. And this 1,200, they are saying that what?
It will be issued half by the shares and half by cash.
So we give you, so this will be 6,000, isn't it?
Yeah, 6,000.
And they will pay 6,000 as cash, isn't it?
Yeah,
So in total, what is the ordinary shares that we are going to be having in the new firm?
36,000.
Is it 36 or 12?
Hey, 12,000.
12,000. Okay. So I'll come here, the, I'll have cash. Okay, they are going to be paying cash of the 6,000. So I have 6,000 here. And I'll have the ordinary shares from the old firm. So I'll just write Brain Limited over here. Okay, Brain Limited. Sorry. Okay, so I'll just have Brain Limited over here. Okay, so this Brain Limited, what will happen is what? We'll be having 6,000 to again, isn't it?
Yeah,
Okay, let's come here. What is the purchase consideration? What are we paying for the equity shares now? How much are we giving to them now?
6,000.
We are giving them only 6,000 for whatever we are taking from them, isn't it?
yes, sir.
Yes, sir.
Okay, so I'll come here and have the 6,000 issue. So you just come here and do purchase consideration. Okay, this purchase consideration is only for the equity shareholder. That is 6,000. Okay, we are paying only 6,000. Okay, we are paying only what? Only 6,000. We are paying only 6,000 to them. Okay, but let's be moving and see. So cash, they will pay cash for 6,000. And the total number of equity shares in the new firm now will be what? 12,000. 6,000 in settlement of their OCS and what? And 6,000 for cash. So if you come here, what are we going to be having here? Let's come to this, please. Let me come to this. Oh, let me come to this place. Okay. Let's come to equity accounts. The equity accounts, what will happen? What is happening here?
You debit the 6,000
So it
ordinary
means that
shares.
what? Okay, whatever we have over here is 6,000 that we are paying to them, isn't it?
Yes, sir.
So we come over here, we have purchase consideration, and now we are paying only 6,000. How that is fine.
Yeah.
Okay, so it means that the loss will be 2,000 plus 20,000 plus 2,000 minus 5890. Then we are paying only 6,000 for that. If you do this one very well, if you do it very well, the loss over here will be the same as the loss in the what? In the realization accounts. Okay. The difference over there will be the loss in the realization account. Very simple. Okay. Let's go to the other parts now. Okay, we are done with the four too, I'm sure. We are done with the four. Okay. Let's come here. The bondholders in Brain Limited agreed to transfer the new company on condition that the bonds will be convertible into ordinary shares after 3 years. The coupon interest rate for the convertible bonds was to be 8% per annum. Similar bonds with no conversion rights attach interest at the rate of 10% per annum. Accrued interest on the bond was to be paid immediately upon taking over. Accrued interest was to be paid immediately afterwards. Accrued interest was to be paid immediately after taking over. So we do that one later. Let's come here. What are they trying to say? They say the bond. What will be the bond now? Would a bond still be a bond in the new firm, or it will not be a convertible bond?
Convertible bond.
Bond.
So if it is convertible bond, what do we do? How do we treat convertible bond?
You look for the
We
How do we
separate
treat
it
convertible?
equity and
equity and the liability portion.
The ability portion you divide.
Okay. So we have to treat this now as a convertible bond by looking for the equity and the liability. So we have to treat this now as convertible bond. So if you are treating this as a convertible bond, you just find the market value of the debt component. How do we find the market value? It is the present value of all the cash flows associated with what? With the debt. So I'll come here, I'll just do this one. I'll do this very simple. So I'll count to, let's say, working number 3, 4. In the new frame, I'll have convertible. So I'll have convertible bond here. Okay, then convertible bond, I'll be having the debt components. So let's determine the debt components. I'll have the years over here. I'll have the cash flow. I'll have the discount factor. The discount factor, we are looking for debts. So if a company is issuing, so the debt company is always, okay, how much if the company is issuing only debt components, what would be the interest rate? So we use that interest rate to find the market value of the what? Of the debt, because whatever that we are paying for, it is based on the amount that you are giving to us today. So the present value of whatever we are paying for is what is going to give us the amount that you are giving us today. Okay, so we use the interest rate of a similar bond without conversion. What it means that if there's no conversion attached to that similar bond, it means that it's purely debt. So if it is purely debt, what is the market value of it? The market value would just be, okay, whatever amount I'm giving to you today is what you are paying in the future, taking into consideration time value of money. So let's reduce the future from it. Let's reduce the time value of money from it and get a principal. So just come here. I'll have, let's check the number of years that we have. So the number of years that we have. Okay. This is going to be redeemed. Okay. After 3 years. Okay. So that will be, we are going to hold it for 3 years. So we have it up to 3 years. Okay. The 3 years we are going to be paying interest. Okay. what will be the rate of the interest that we are going to be paying? What is now the interest? What is now the new interest rate that we are going to be paying on the bond that we are issuing? First, it was 12%. Now they are saying that the interest rate was to be what? The interest rate, the coupon interest rate for the bond was to be what? Please forget about the 12%. We are now in a new firm. The new firm, the bonds will now be paying interest at 8%.
Yes, sir.
Okay, what will be the value? 8% multiplied by the nominal value. I'm sure that is 12,500 or something. Yeah.
1,000.
Okay. This thousand, how many years are we going to receive the thousand?
3 years.
For
3 years.
3 years.
That's why we are making it 1, 2, 3 perpetuity. At the end of the 3 years, what will happen? It will be redeemed, isn't it?
Yes, sir.
Yes.
At what? At par.
Yeah.
Okay. So that is 12,500. So let's just find the discount factor and then annuity. 10% 3 years annuity.
2.487.
Okay, 2.487. Discount factor 3 years. At the end of the third year, 1 over 1.1 is 0.3.
0.751.
0.751. Let's multiply them. What are we doing?
The first one is 2487.
2487. Okay.
And the second one is 9388.
9388. Total is what?
Total is 11875.
11875. But how much are we? This is a debt component. How much are we receiving?
12500.
So what is the difference?
626.
Okay. Other components of equity is 6
6.
is it 626 or 625?
625.
Okay. So if you go to the new firm, we now have 8% more at 11875, and we treat the remaining portion as other components of equity. So if we go to the new firm, we do that. This one is not going to result in any gain. In the same 12,500 that we are going to be giving to them, but we will make sure that they will have the option to convert. So what is the value of the option to convert into this term? And what is the debt component? That's what we are separating. So we don't have any issue about that one. We are giving them 12,500 for 12,500. No issue. Okay. The current liabilities of Brain Limited were transferred to Delta Limited at their book value. So over here, I can now start doing statement of financial. Okay, so I can now start doing statement of financial position. So let's see if we can start statement of financial position on this side. So we have the B side, opening statement of financial position of Delta Limited. We are doing this for Delta Limited, a new firm. So we now come here and have the asset value. So we have non-current assets. Non-current assets. So this non-current asset, what we have over here is that we have the PP. What is the value of the PP? What is the fair
29,
value?
29,200.
29,200. Okay. They are not taking the brown, isn't it?
Yes.
So we come to current assets. So current assets, how much are they taking the inventory?
3870.
3870. Okay. Receivables,
Receivables is 3640.
36. Okay, 3640. Okay,
So you paid for 600 cities.
okay. Let's come to equity and liabilities. Okay, please, mostly the consideration will be the consideration will be given to you. They will give you how to calculate the consideration, not that you will come and you will come and be you will come and be adding the fair value of the asset and subtracting the liability that they are taking. The consideration might not be the same as that one because they might be paying for something that is not existing, which is the goodwill. So you can only calculate the consideration using the asset when you have a goodwill. Okay, so they will give you how the consideration has been calculated. So they'll say the entity has issued this amount for the net assets and whatever. Okay, so you won't do anything. Then we'll come to the equity here. Okay, we will do equity, which is the share capital. We are doing that. We are not done yet. There will not be any return earnings and there will not be any revaluation results because it's a new company that is starting. So nothing like that will come. There will not be any preference shares because we have converted the preference shares to whatever we are doing. So we come to here and have other components of equity. I hope you agree to that. Other components of equity. Okay, and that will give us 625, isn't it? Okay,
Yes.
that might be other stuff. So let's leave a space like 2. I'll come here and have non-current liabilities. Non-current liabilities will be having 8% what? Bond. Or you can change it to convertible bond, no problem. So 8% convertible bond. Or you can, under the equity, you can just write convertible bond. It means that that is the equity portion of the convertible bond. Okay, convertible. That will give us 1875. I hope that is fine. Okay.
Yes.
We now come to our current liabilities. Current liabilities. We'll be having the payables. How much is the payables? They are transferred at carrying value. So how much?
150 and 30.
Payables. The carrying value is what?
Yeah, with the carrying value is 3050.
3050. Then the bank overdrafts.
2250.
Okay, they are saying that the interest will be paid after taking over, isn't it? If you look at accrued interest on the bonds was to be paid immediately upon what? The 5. The accrued interest on the bond was to be paid immediately afterwards.
Upon taking over.
So are they going to be having that as a liability in their books again?
No.
Okay, so we go to their cash accounts now and write that one off because they are paying. Okay, it is a new firm that will pay. So we come over here and have accrued interest. Okay, how much is it?
That's 750.
750. So we now have this as a liability. We pay that one off. Okay, we'll pay this one off. Okay, let's come to whatever we are going to be doing here. Okay, so let's come here. Tangible assets. Tangible asset. The brand that was considered to be worthless. We have done that already. The tangible assets were taken over by the Delta Limited at their fair value as follows. The tangible assets we are taken over by the Delta Limited at their we have done that already. Liquidation expenses of Brand Limited amount to 6 million, and we are settled by what?
Delta Limited.
Okay, would this be resulting in any gain or loss? We are paying 6,000. They are still giving us 6,000 to us. Are we losing anything?
No, we are not losing anything.
Okay, so you just do this because you want to get more tips. This is what you do. You come here and write liquidation expenses because it's an expense. Okay, so you have liquidation expense. So you have 6,000 because they are giving you 6 million. So I'm sure three zeros at the top. Okay. Okay. Then you come here and still what? Repeat the liquidation, or you can add it to the purchase consideration. That will still be 6,000. You can see that it's having zero effect, isn't it?
Yes.
Okay. So you just do it for multis. Okay. You do it for multis. It is going to be having zero effect. But if the entity is paying the liquidation themselves, that is going to be an expense for them. Okay. It's just like reconstruction cost. That is an expense for you. So you just bring it over here at the debit side as an expense. Okay, but this one you are paying and you are doing the same thing. So liquidation expense will now be paid by the new firm. So we come here and have liquidation expense being paid by the new firm. Their cash will be going out. So we have 6,000 as liquidation expense. Okay. Then the last part, I will not touch the last part. It is entirely for the new firm now. Immediately upon takeover, the Limited invited its shareholders for a 145 right issue of ordinary shares at an exercise price of 15 cedis. The average market price of the ordinary shares on cum right basis immediately before the right issue was 120. The issue was fully subscribed. So this question might only be for maybe they're asking for the end part of it might be for you. They're asking to calculate earnings per share. We are not interested. We are buying the shares at 15 cedis. That is the end of it. Okay. So whether they are issuing at a bonus issue or something is none of our business. Okay, the shares were trading at 20 cities, but the people are now buying 15 cities. So how much are they going to be paying? That's our interest. So whether this is going to be reducing our earnings per share or something, that is none of our business. We are not calculating any per share. So this is for the old firm. This is for the old firm. This is for the new firm. Okay, this is for the new firm. So I will not do anything about this for now. But let's total something so that I can do the opposite side of realization account for you. Okay, let's total this. What are we having? What is this thing? The debit side is how much? Realization accounts. Someone should be doing the debit side and the credit side as well.
The debit side is 56,590.
5, 6.
56,590.
Mm-hmm.
Okay. Credit side,
Credit side,
The
40590.
4059 was.
zero.
Zero.
Okay, what is the difference?
16,000.
16.
1,000.
I'm not sure. Check it. Just add again.
The
Okay.
debit is 5,700.
The debit is what?
5,700.
5,700.
Okay. You see, whatever difference that you are going to be getting will be the difference on the debit side of the equity account. What are you getting? Is the 4590 correct?
Yeah, the 4590 is correct.
So what is the difference now?
10,110.
10,000.
110.
That is going to be a realization loss, isn't it?
Yes.
That will be for the equity shareholders, isn't it?
Mm-hmm.
10,
10,000.
110, isn't it?
Yes.
Check the equity side here. Check the difference between the equity side.
Yeah, you get the same thing.
Same thing.
It's the same thing, isn't it? So that
Yes,
that
Yes,
figure
sir.
should give
Yeah.
you that should give you the same loss. Are you okay? So realization loss. Okay. So I will still do this 10,110. This is a realization loss. So you can have your 22,000 here. 22,000 here. Okay. But I've said something that so I'll be dropping what I'm saying now. You can do it in so many ways. I'm saying something that you can decide to treat the brand straightforward in what in the equity account as a debit, isn't it?
Yeah.
Okay. If you take the brand away from this, you realize that your loss will be what? The loss will not be 10,110 again. It will be 10,110 minus the 44,000 for the 4,800 because the 4,800 will not be at the debit side again. And what are you going to
Yes.
be having?
5310.
Yes.
One
Five
fifty.
110.
three one zero.
5,310. And you see that the 4,800 will come here, isn't it?
Yeah.
Yes.
If you add it, what are you getting?
You still get
The same loss, isn't it?
yes. Yes, the same thing.
So you can decide to take those assets that will be worthless to realization account straightforward, or you can decide to bring it to the equity account as a reduction. At the end of the day, it will add up to the total loss. Okay. Let me also hold another way of calculating the
Senior.
realization. Yes, please.
So every time must the equity account be equal to the realization. That is if you make a loss.
Yeah, the loss must be the same as the realization loss relating to the equity, because
So
that is
how
the figure that
about
will close the
gain?
equity account.
But say what happened to the retained earnings, the debit retained earnings?
It is going to reduce the debit return is going to reduce the equity account.
Okay.
It will be written against the equity. So you can see that the equity value, if you do it from the statement of financial position, it is 20,000 plus 2,000 minus 5890. What are you getting?
That will be 16,110.
But
Yes.
how much are we paying for it? How much are we paying for the equity shareholder? It's not 6,000 that they are paying for the old firm.
Yes, yes, 6,000.
So it means that they are losing how much?
10,110.
Okay, and that 10,110, you can see that 10,110, we are calculating this in a different way. Why is it a different way? You can see that the 16 something that you have gotten. Okay, the 16 something that you have gotten. It's just the total asset minus total liabilities minus the return earnings. Do you agree?
Yeah.
Yes.
And that is what we are doing in the realization accounts. So you can see that the way we are calculating the equity value is the same thing we are doing in realization accounts. So our equity value here is 2,000, is 20,000 plus 2,000 minus the 5890. It's the same thing as the total asset minus total liabilities. Then subtract the return earnings from it.
Okay.
Then that will give us the 16 something that we have gotten. So you can see that it's the same thing. That's why I'm saying that you can add the return earnings over here. You can bring the return earnings of 5890 here. Okay. If you bring the return earnings over here, then your total loss over here will be this figure plus this figure, which will be 16,000. If you
Yeah.
put a 5890 here, it will be 16,000. It means that the loss, the return earnings reduction is already included in the loss. So you
Okay.
don't have to treat the return earnings again. Okay.
Okay.
So I'm saying that
Okay.
you can also do I've spoken about the brand. You can decide to bring the brand straight forward, and we have seen the effect also, isn't it?
Yes.
Okay.
Okay. Okay. So that is one way of doing it. I'm saying that this realization account can be prepared for the company as a whole, which is going to be including the loss relating to the shareholders and the loss relating to what? To the equity shareholders, the equity shareholders, and the preference shareholders, and also maybe any other liability that we have. In that case, how do we prepare it? We prepare everything, but this is what we do. Okay. It's the same thing, but I will bring something here. It's not any different thing. It's the same thing that we are going to be doing. Okay. But this will now be presented in a very different way. Okay. Let me do it over here. So that's okay. Let me do it over here so that we can be able to get it. So this is an alternative to the realization account, but I'll take it off. Okay. Because I don't want to confuse you. So I'll come here. I'll come here. Okay. I'll come here and do this. Okay. So I'll bring all the asset value now. Okay, so straightforward, I'll just bring total asset over here because we have done that already.
Mhm.
So total asset is 5,700, isn't it?
Yes.
Okay. So some of the liabilities, I'll not be receiving any amount for the liability. So I'll bring the payables here. So you see that the payables will be transferred as current value, isn't it?
Yes, sir.
It means that there will not be any gain or loss. So the payables will still be at the 30/20. I hope that is correct. Or 30/50 rather.
30/90.
Is it 30? Okay, 30/90. Sorry. So the bank overdraft will be what?
22/50.
Bank overdrafts. So bank overdraft will also be 32
22.
2250.
to 50. You consider the accrued interest, we are paying the same amount for it, isn't it? They are paying
Yeah.
the 750. So it means that the same 750 will be realized. Okay. Then what I will do is I will calculate the purchase consideration now. I will not bring irredeemable preference shares. I will only bring the amount that they are paying for the irredeemable preference shares. I'll bring the amount that they are paying for the irredeemable preference shares. So if it is 10,000 that they are paying, I'll put the 10,000 in the purchase consideration. It means that if the purchase consideration is over here, we are subtracting the 10,000. So I will come and do the purchase consideration like this. I'll do the purchase consideration like this. So I'll come here. I will have purchase consideration. So let me come here. I'll have purchase consideration like this. So the purchase consideration, I will look at the amount that we are paying, they are paying. You can see that they will pay for the preference shares. They are
Mhm.
giving them shares at 5 CD, which is equivalent to 10,000. Do you agree?
Yes.
So you can see that they are paying 10,000 for 10,000. Is that correct? Okay.
Okay.
The equity shares, they are paying 6,000. Do you agree?
Yes.
You can see that they are paying dividends. They are paying some portion of the dividend for what? 1,000.
Mhm.
Okay. They are paying liquidation expenses. You can see that all these are payments that is going to be from the new firm. Liquidation
Yes.
expenses of how much?
6,000.
6,000. Okay. We didn't bring their bond. They are paying all the value for the bond, so there will not be any loss on the bond. So I'll bring the 12,500 here. Although they are not paying, they are taking all of them. I hope that is fine.
Yes.
Okay. The dividends, we are going to be bringing the dividend to the books. So the dividend will be a cost because we are going to be paying. But they want to pay only 1,000 out of it. We're supposed to pay 20. We're supposed to pay 2,000. So we come here and pay 2,000. Okay. The liquidation expenses, we will incur liquidation expenses, but they are paying it to us. Okay. They are paying the liquidation expense to us. So we bring the 6,000 there. But you can see that the 6,000 is part of the purchase consideration. What would be the total purchase consideration?
23,000.
23,000. Okay. So I'll just bring the purchase consideration here as 23,000. Okay. You can see that included in this 23,000 is the what? Is the preference shares that we're supposed to subtract 10,000. So you can see that 10,000 has already been subtracted, isn't it?
Yes, sir.
Okay. You can see that the 6,000 that we are putting over here, the 6,000 is already over here. So it's having zero effect, isn't it?
Yes, sir.
Okay. The 12% bond, we're supposed to subtract 12,500. But if the question is saying that they are paying only 2,000, it means that I will not subtract this again. I will include the 2,000 in the purchase, the 12,000 in the purchase consideration. It means that I'm under subtracting this place by 500. So that 500 is already a loss in this one. So I'm calculating the loss for the total firm. Okay, but if you are subtracting the actual value, it means that you are looking for only equity value. So I'll come here. What will now be this place? I'm sure this will be 58,700. Okay. What will now be the difference over here? Then you calculate the loss. Let's see something. I'm sure you'll be having 111 1-0, if I'm not mistaken. As a loss. Check.
So I'm getting 17110.
1-7.
17110.
No, I'm sure that cannot be possible. Okay, let me go here and bring those values again. So check again, check well again. That cannot be possible. Okay, we have 30. The asset side was, oh, sorry, we brought liquidation already. Sorry. Okay, liquidation was already part of that one, the 5700, isn't it? Okay, the liquidation was already part of it, so this should be taken off. Okay, liquidation was already part of that part, that portion, so this should be 50. This should be 52, 700. How that is fine now. The 57 and liquidation is already part of it. Okay, so what are we having?
That is one
Yeah.
one one
One
one
one
zero.
one
Yeah.
one zero.
Okay, you see this 1110100 is the loss arising from the total business that we are doing, or the total transfer that we are doing. Okay, then you have to share this loss now amount equity and liability, equity and preference shares. You can just one this one you just be able to identify very easy. How do you identify it? How much should have been paid to the equity shareholders? No, don't use the equity first. How much should have been paid to the preference shareholders? Okay, this is the amount that is supposed to pay, but how much has been paid? You determine that. Okay, is there any loss? Then that loss has been captured over here. You take it away. You go to the debenture holders. How much should have been paid for them? This is the amount. This is the amount they have paid. So there's a loss of this one. This loss is also included over here because we are doing the loss for the total transfer. Let's come here. Is there any loss on payables, bank overdraft, accrued interest, and the 12% bond? Are we transferring? Are we receiving less than what we're supposed to receive?
No, sir.
No, sir. So there is no loss there. But let's come here. What is the dividend that is due to the preference shareholders?
It was 2,000.
But how much are they paying?
1,000.
1,000.
So what is happening there?
They have lost 1,000.
Okay. So your realization loss now, you do the loss, 1,000 will go to the preference shareholders, which is 1,000. And the equity shareholders will now bring the what? The 10,110 to them. So you can see that the only thing that you are bringing over here is you are capturing the dividends in this one. But the dividends is supposed to be 2,000, but they are paying 1,000. It means that the preference shareholders are losing that 1,000. And that 1,000 we have done it somewhere. What is it? What is 1,000 for? The ordinary shareholders. We have done 1,000 no. The preference shareholders, we have done 1,000 somewhere for them. Okay, you see that we are saying that 1,000 will come here as a loss, isn't it? 12,000 against 11,000. So you just bring the loss over here, the loss, realization loss over here as 1,000. You can see that the equity, the loss that we are getting for them is the same 10, 10, 10. So which of them would you like to do? You do the realization for only equity and determine for the other ones. Which of them do you want? Or you do it for the total company and now share? Will you want the first one that you do the realization for only equity to determine the loss and give it to equity, and you now determine whether there is a loss or a gain on the transaction relating to other stakeholders, or you do the total loss arising from the business, then you now apportion them now to equity and liability. or equity and preference shareholders, and or maybe some debt holders? Which of them do you want?
The first one is good.
Okay. Nobody's going to penalize you for whatever you have done. Okay. Since you are going to be getting the same answer at the end, that is it. Okay. So me, I normally advise the first one, although I also teach the second one. Okay. And in the ICA manner, maybe if they have adapted it, they'll be using the second one. And it's the second one that I've captured in the lecture notes as debit this and this, please. Don't go and stress yourself. Okay. You are looking for equity. How much has been paid? What is the loss? The loss will be given to equity shareholders. Then the new firm now, let's come to the new firm. Very simple. We need to do what we need to determine whether the new firm is paying more for whatever they are buying or they are paying less. So this is what we do. Very simple. Okay. We come here. What do we do? How do we calculate goodwill? The fair value of the net assets compared to what? The purchase consideration, isn't it?
Yes, sir.
Okay. So let's come to the calculation of goodwill now. I'll come here. Okay, can I do goodwill calculation here? So let me take this one off and do goodwill calculation over here. So let me do goodwill calculation here. So this, the goodwill calculation, we call it, there's a name that we have been calling that one. Okay, I'm sure it's purchase of business or business combination. There's an account that we have been using. I'm sure it's business combination or purchase of business or acquisition of business or something. But don't worry, me, I'll just say goodwill calculation. We compare how much they are paying and how much supposed to be paid. Okay, so this is why you pay attention to something here. Okay, so I'll come to calculation of goodwill here. Okay, I'll come to calculation of goodwill. We just compare how much they are paying and how much supposed to pay. Okay, you can see that we are receiving the assets. So we look at the asset value that we are receiving. Should I do vertical or I should do horizontal? I'm sure horizontal will help, isn't it? Okay. This is also prepared on the, so if you are doing horizontal, then you just call it what? Uh Purchase of business accounts. Okay, so let me just say you have purchase of business accounts. Okay, or purchase of business accounts. Okay, so this one we prepare is based on what? Based on the double entry. Okay, so what will happen? The entity will be what? The entity will be, if the entity is receiving the asset, they will be debiting the asset in their statement of financial position. Is that correct?
Yes.
Okay, so what we do over here is that we credit all the assets. What is the asset that they are receiving? The first one is plant and equipment. They will receive the assets. Whatever we are doing, we are paying for the assets. Okay, we are paying for the assets at the fair value. It's goodwill. We look at the fair value of the assets against what? Against the fair value of the asset that we are buying, against what? The amount that we are paying. Very simple. So we come here, I'll have 29,200. Do you agree? I'll have inventories to be 3870. I'll be having receivables. We are not taking any cash for them. They don't have cash accounts. I hope that is fine. 3640. Okay, this is a total asset, isn't it? This is the asset that we're supposed to receive. So if we are receiving total assets, but we are receiving we are assuming some liabilities in addition. So this is total assets, but we are paying for only the net assets. So we have to take the value of the liabilities that we are receiving. So I'll come here, I will come to the 12% bond. Okay. So we are only paying for the net asset. So that is why you have the value of the asset less the non-controlling interest. So we are not buying the total firm, no. We are only buying portion. So the 12% is the liability that we are not controlling. So we'll come here, we are paying all the 12,500. So this one, the purchase of business combination will be done at fair value. I'm taking the asset at fair value. So that is the amount that's supposed to pay for the asset. So what is the liability component? It's just the net asset. I'm buying the net asset. So what is the fair value of the net asset that I'm buying and how much am I paying? Very simple. I'll come here, I'll come and do bank overdrafts because this asset that I'm receiving, They are all financed through both equity and liabilities, and I'm looking for the equity component. So I'll come here. I'm sure that the bank overdraft is 2250. Okay. Then I'll have payables. The payables is 3050. I'll have accrued interest. Okay, I'm taking the accrued interest also from them, but I've decided to pay it. It doesn't mean that I haven't taken this one from them. So the accrued interest will also be taken away. Okay, and I'll come here. I will come here. I will do. There's another one. There's another one. There's another one. What again? Yeah. So I have
David,
irredeemable. I have irredeemable preference shares. How much is it? How much am I paying for them?
10,000.
I'm paying 10,000. Okay. I'm paying 10,000. Okay. So let's come here. I will tell you another thing now. I will tell you another thing now. Okay. You can see that all this amount that we are paying, there are something that existing that we are paying for, isn't it? There are something that we are paying
Yes,
for.
yes.
Okay. The liquidation expense that we are paying, the liquidation expense that we are paying is a cost that we are incurring, isn't it?
Yes, sir.
That will be a cost to us. But the question can tell you the entity has agreed to spread the liquidation expense over 4 years or something. So you treat the liquidation as an intangible asset. But if nothing has been said about the liquidation expense, we assume that the liquidation expense is what is we assume that the liquidation expense is going to be treated as a goodwill because that should be expense for the entity that will be taken to profit or loss. But we assume it in what those things that we cannot, those intangible assets that are not having a value or we cannot determine. We classify all of them as goodwill. So another thing also over here is we are going to be determining how much we are paying. So let's come here. How much should be paid for the asset based on the information that we have over here? How much should be paid for the assets? The total asset is this figure, and these are the liabilities that we are assuming. So we take the liabilities from it and have the net asset. So the net asset will be total asset minus the fair value liabilities that we are having. Okay. How much are we going to be? How much are supposed to be paid?
I have
8120.
so
That will be 81.
20.
Okay, 8120. Okay. But we paid what? We paid 6,000 for the equity, isn't it?
Yeah.
Okay. If we haven't paid any amount, it means that we just compare the 6,000 with that one. It means that we're supposed to pay more, but we are paying less. That will be a gain or bargain purchase, but that's not the issue. Let's come here. Okay. We are saying that the liquidation expense that we are settling, unless the question is telling you that the entity has decided to treat the liquidation expense as what, maybe intangible asset for 3 years, then you will not separate the liquidation expense and treat it as what, as an intangible asset. But if nothing has been said, the amount that we are paying for the liquidation expense, we are willing to pay that liquidation expense because we have seen that this particular company is having a good name or is going to be profitable or is having a good location so that if we are able to get them, we'll be able to make profits. So we accrued or we actually equal or equate. We actually equate the liquidation expense. Okay, if I'm having difficulties now and you want to buy me or you want to buy my company, you will only be able to help me pay some expenses to liquidate the company or to close the company if you realize that okay, this company is going to give you a lot of benefits. So it is assumed that whatever amount that you are paying for something that is not there, it is because of the good location or something that is not there that you are saying that if you should have this company, you are going to make profit. So you can help them to do that. You can help them to clear everything so that you buy them and you start making profits. So the liquidation expense is going to be assumed as something that we are paying for something. We are paying this because of something that is invisible to the entity. Because the company is not going to be profitable, there is no way you help them to liquidate. You tell them that, oh, incur your own expenses, and if you are done, you come, I'll pay. But you only help them to pay when you realize that, no, if I don't acquire this company, something is going to happen, or this company is having potential. So I want to help them so that they can do fast, and I will take them and make profits. So the liquidation expense over here, it is going to be equated to goodwill. So we add the liquidation expense as part of what we are paying. So this will be part of our purchase consideration. Okay. The dividends that they are owing, the dividend that they are owing is the dividends in the books of the entity. Is the dividend a liability? Is it a
No,
liability in the books of the entity?
no, sir.
So do we have to assume that liability?
No.
But we are willing to pay 1,000 of it.
Yeah.
Yes.
Okay. Why do you think they are willing to pay the 1,000? Okay. They are willing to pay the 1,000 because they want to what? They want to take the assets of the company. Why would you want to take asset of that? It means that that company is going to be profitable, but they are not managing very well. So we are willing because it's going to give us the benefits. So the goodwill that we are going to be paying, any amount that we are going to be paying for something that is not there, it will be added. So we now come here, our purchase consideration will now be like this. We will be having the 6,000 that we are paying for the equity. For this one, we are paying it for the asset that is existing. But 6,000, which is liquidation expenses, there's no obligation, but we are paying. So we add it. We are paying for something. We are paying because there's something unique about them. So we add it. We come to the 1,000 over here. Okay. We come to the 1,000 over here. We'll be having this plus this. So we'll be having 13,000 as the what? As the purchase consideration. So I'll come here. I'll have 13,000 as a purchase consideration. Okay. Or you can subtract the 6,000. These two amount that you are paying, 6,000 and this thing, they are always consumed as part of goodwill. So you can have this figure and subtract. Let's now subtract and see what we'll be getting. 29,200 plus 38,70 plus 36,40. What are we having?
3710.
30,
3710.
okay, 37, 36, 710. But how much are we paying? How much should have been paid? It should have been a liability, the asset minus the liability. You have mentioned a figure. You have mentioned a particular figure. The time is up. 8120.
8120.
But how much are we giving them now?
Now we are giving them
13,000, isn't it?
13,000.
So how much is giving in excess? How much are we paying in excess?
We are paying 4880.
4880. Okay. So this is what we call the goodwill. Okay. So the difference over here is goodwill. So if you have to pay them anything, you have to pay them out to the 8,000. That is the remaining amount. So you'll be willing to pay them up to that amount, but you are willing to give them amounts more than that for nothing. You are giving the 6,000 for the assets, but you are giving the additional 7,000 for nothing. You can see that 7,000 you are giving them for nothing because it's not something that you are going to be paying for. The dividend is not an obligation that you have to perform to the preference shareholder. The liquidation expense is not an obligation because the entity have to incur their own expenses before you acquire them. But you are now willing to do that for them. You are doing this because of something that the company is having that they cannot see. And that particular thing is equated to goodwill. So you're supposed to give them only 8,000 to balance everything. But you are giving them 13,000. It means that you are giving them more than what is supposed to receive from you. You are giving them 6,000 for the asset. You are giving them 6,000 for liquidation expenses that you don't have to settle. You are giving 1,000 for dividend that you don't have to settle. So the difference over here is what we call the goodwill. So I'll come to the statement of financial position now. Then I'll come under this one. I have goodwill. So I'll come to goodwill over here, and I'll do the 4880. Okay. So, okay, I've spoken about how you can do it, do the total one for them and share. We have done that already also. So let me just come to, okay, let me take this one off. Okay, I'm sure this to be off now. Let me come here. Okay, this should also be off. This should also be off. Then let's now take the last additional information that we can now do something here. This is right issue. They say immediately after takeover, the LA Limited invited its ordinary shareholders for 1 for 5 right issue of ordinary shares at an exercise price of 15 cedis. So we are issuing shares, which is bring 5 of your existing shares for 1 new at 15 cedis. We need to determine the number of what? The number of shares in the LA Limited now. We need to determine the number of shares in the LA Limited. How do we determine that? We have to go and look for their equity accounts. Okay. What is the value on the entity's equity accounts now? What is the total value? Let's determine that. The new firm, what is the total value on the equity accounts? We are having
43,000.
43,000. Okay, is that 43?
Say 33,000.
33,000.
Are you sure?
Yeah.
We are giving 10,000 for the redeemable shares, and we are issuing 10,000 again for cash. We are giving 1,000 Ghana cedis for what? For dividends, and we are giving 6,000 for the equity shareholders in the old firm, and we are issuing new shares at 6,000 for them. If you put the two together, that is 33,000, isn't it?
Yes,
Okay.
sir.
How much is a share?
10.
Okay. So how many? What will be the number of shares now?
3,300.
Yes.
Okay. 3,300. Okay. What is the proportion for the rights issue?
1/5.
1/5.
1/5. So let's look at the number of shares that we can issue from the rights issue. So I'll come here and do something about rights issue. Okay. So I'll come and do something about right issue. So let me go top small. I'll have right issue there. So the right issue, I'll have 1/5 multiplied by 3,300 shares, isn't it?
Yeah.
How many shares are we going to be getting?
660.
660 shares. Okay. We are issuing these shares at what?
At 15 cedis.
But the shares should have been issued at how much before?
20 cedis.
Are you sure?
10 cities.
It should have been issued at 10 cities. Okay. But we are issued at 15 cities. So what is happening?
Don't be again.
No, there is a premium. Okay.
Oh,
There's a
premium.
premium. Okay, so we share this now. We will be having 660 multiplied by 10 CD to equity shares account. That will be 6,600. I hope we agree. Then we come to the share premium. The share premium will now be the 660 multiplied by 5 CDs. How much are we having? I'm sure that will give us
3,000.
3,000. Okay, what is the total amount that we are going to realizing from this?
9,900.
So I'll just come here and do my right issue. Okay, right issue, I'll be having 9,900. Our 9,900, our what will be increasing? Our cash will be increasing. Our equity will be increasing by how much? Okay, so right issue, our equity will be increasing by only 6,600. How that is fine.
Yeah.
And this will give us 39,600. Is that correct?
Yeah,
Yes.
3,600.
Okay. So I have balance carry down here, 39,600. So I'll come here, 39,600. So I'll come to my statement of financial position. I'll come here, I'll come under equity. So I'll have equity is, so let's say like is 3 or something. Equity is 39,600. Then I'll have share premium. Okay. Share premium to be 3,300. How that is fine.
Yes.
Yeah.
This will be 5,300. So I'm sure you can now add your figures now and move on. I'm sure this is 7,510. Is that correct?
So what about the cash?
What happens to the cash?
Did they have cash?
Yeah, cash. We
Yeah.
open a cash
Oh,
account.
sorry. Okay. So let's put out the cash. Sorry. So we have cash and cash equivalents. Sorry. What is it? What is a cash account?
25150.
The total.
The total is 25900. The
So
balance sheet
two
is 25150.
25150. So 25150. So the total is what?
No, the total is 198. The balance sheet instead is 19150, and the total is 25900.
Two five
25900, and the balance sheet is 19150.
1915. Okay. So we have okay. 19150. Okay, if you put them together now, what are you having?
26660.
2666. The six are three.
Yeah.
Okay. What about the non-current asset?
The no current 34080.
34080. What are you having?
The total is 6740.
Okay. Total equity.
Total equity 43525.
435. Add that to liability.
Yeah. Should be not coming.
5340.
Are you sure? We have 118750.
No, the 5340 was the true current life.
53.
No, sir. We are getting 6700.
700.
67.
60.
700.
So no, sir, the
The,
total is 6740.
okay, what is the difference? Check the payables. Is the
The
payables
payable
3090?
3090.
The payables is 3090.
Yeah.
So it means that this one too, the this thing over here is wrong. The goodwill is wrong,
Yeah.
isn't it?
No, the good way is correct. The good way is 4880.
So it means that I should make this one 3090 rather, not 3050.
Yes, sir.
But if I make it 3090, it's still the goodwill will still be the same, isn't it?
Yeah, the good will be the same.
Okay. So this will be 3090. Yeah. Okay. Oh, I was using. Okay. So I was using 3050.
So
Where from that?
so the current liabilities, the total will be 5340.
Okay, 3090. Thank you. Okay. 5340.
Yeah.
Okay. So let me go to 250, 340. Okay. Okay, please. I don't think you should have problem with this one. Okay. Uh, I don't think you should have problem. Any of them that you are using, whether to find the total loss and share or whether to find the loss for just equity from the realization account and determine the loss in their individual stakeholders accounts. At the end of the day, you should not be having problem there. Okay. You should not be having problem determining or closing the books of the old firm and coming to the new firm. The new firm assets and liabilities will be carried out their fair value. Okay. And then some of the liability might be paid off, like how we have the accrued interest. We have paid it. So that will be reducing their cash. Then if you are doing a good job, you just ask yourself, what is the value of the asset I'm taking? And what is the value of the liability that I'm pursuing? The asset that you are having is a total asset. So we are only paying for the net assets because we have taken the liabilities from them already. So we are paying for the net assets. So how will I determine the fair value of the net assets? It's just the total value, the total fair value of the assets minus what the liabilities that you have assumed. Then you just compare to the amount that you have paid. What is the amount that you have paid? The amount that you pay to the equity shareholders and also the amount that you pay to other items which have no obligation or which you have no obligation to pay. And that will always be the dividend that is accrued that you are paying. It can also be some interest that is being accrued, but it is not in the book. So you are paying for it. You have to also add that one to determine your good job. Okay. So this one, okay, I will not do the 15 because the 15 I will do that 15 during intervention. Okay. So they can maybe, I don't know. The first sitting was capital reduction. Second sitting was business valuation. And this is a new topic. Okay. This is a new topic. So this new topic there, maybe they can decide to bring it. And if they want to bring it, maybe it can be any of the two questions that we have solved. I don't know, but maybe it can be any of them. Okay, because I don't think whether they have questions on this one in the manual. If you have the manual or the question bank, I don't think they have any proper questions on this. Okay, and I'm not sure they will bring questions from the question bank. I'm not sure. How do they can do that? But I'm not sure. Okay, but this should not be an issue to you. I have some other question on that. Okay, I'll I'll give them to you to try. I said I'll give you a compilation of questions that you try. You can, if you, based on the things that we have done so far, if you finish, you can send it to me to have a look at it, or you can call me so that we discuss it. Or not that you call me to go and do the work for you. You have done it and you are struggling somewhere and you want me to assist you. Randy, last time I said I'll call you. I've called you and you need coming back. Okay. So I don't know whether
Okay.
you have seen the solution to that one, but I'm sure I've solved that question before, but it might be a different city, maybe some two cities ago. Okay, but I can't
Okay.
remember. If not, I will just direct you to go and watch that video. I don't think the video is still there, but every question in the lecture notes, in one way or the other, I've solved them before. Okay, but not just in one city, maybe in different cities. Okay, but I can't remember, so maybe tomorrow you can call me. Okay.
Okay, sir.
Okay. If there are no issues, seniors, you can try the other ones. I will solve the 15 for you during revision class. Okay. Thank you for coming.